Picture this. You pick up a brand new phone at a Lumina Mobile store and you walk out without paying a single cent. It's free. But that night in Lumina's books, something strange happens. They record money earned on the phone they just gave away. How? How can free turn into money? Stick with me, and by the end, you'll know exactly how. The tool that cracks it is IFRS 15, one model, 5 simple questions for any sale on Earth. First, why did this even change? For decades, two old standards ran revenue. I as 18 for goods and services, I as 11 for construction. Two rule books, often pulling different ways. IFRS 15 swept them into one. And the heart of it is a single shift. The old question was, have the risks and rewards passed? The new question is simpler. Has control passed to the customer? That one change ripples through everything. Goods, services, construction, bundles, all judged the same way now. And look at the last row. Under the old rules, our free phone often showed zero revenue upfront. Under IFRS 15, 240 euros on day one. Hold that number. By the end, you'll see exactly where it comes from. But before we dive in, where does IFRS 15 actually rule? Its kingdom is simple. Any contract with a customer to deliver goods or services, sales, subscriptions, construction, licenses, bundles, all of it. But not everything. Leases belong to IFRS 16, financial instruments to IFRS 9, insurance to IFRS 17. The test is easy. If it's a customer buying your product or service, IFRS 15 is your rule book. Part 1. The 5-step model, the engine behind every single answer. So how do we get there? 5 steps. Think of them as 5 questions you ask of any deal on Earth. 1. Is there a contract? 2. What exactly did we promise? 3. What's the total price? 4. How do we split that price across our promises? And 5. When do we actually count the revenue? 5 questions. Let's put them to our phone plan, one at a time. Step 1 of 5. Is there a contract? It has to be enforceable, with clear payment terms, and we're reasonably sure we'll be paid. Our 24-month plan? Easily yes. Quick pause on that phrase because the whole standard hangs off it. A performance obligation sounds technical. It just means a distinct promise, something you hand over that the customer can use on its own. Our phone plan? 2 promises, the phone and the service. 2 performance obligations, that's all it means. Keep that picture. Everything builds on it. So 2 separate promises, and splitting a deal into its real promises is exactly what the old rules kept getting wrong. Quick pause on that phrase because the whole standard hangs off it. A performance obligation sounds technical. It just means a distinct promise, something you hand over that the customer can use on its own. Our phone plan? 2 promises, the phone and the service. 2 performance obligations, that's all it means. Keep that picture. Everything builds on it. Step 3, the price. 30 euros a month, 24 months, 720 euros in total, easy. Step 4 is where it gets clever. We split that 720 across our 2 promises, but not by what the contract calls them. The phone says free. We ignore that. Instead, we split by what each would sell for on its own. Phone alone, 300. Service alone, 600, 900 together. So the phone slice is 720 times 300 over 900, 240 euros. There it is, our mystery number. The free phone was never free in the accounts. It carries 240 euros of revenue. Half the mystery solved. Now, when do we count it? Step 5, timing. When does revenue count? The phone? The instant it's in the customer's hands. Control has passed. That's day one. One more plain English moment. A contract asset is simply revenue you've earned but haven't billed yet. You've handed something over, the cash is still coming. It's not a receivable. A receivable is money you're plainly owed, just waiting on time. A contract asset still depends on you doing more, like delivering the rest of the service. Small distinction, big deal to auditors. Which means, on day one, we've earned 240 euros on the phone, but the customer hasn't paid a cent yet. They pay monthly. So we park it as a contract asset. Debit contract asset 240, credit revenue 240. And there's our answer. That's how a free phone makes money on day one. Mystery solved. But revenue is only half of it. Here's the matching half. That handset cost the company 200 euros. It moves to cost of sales now, recognized right beside the revenue it earned. One more plain English moment. A contract asset is simply revenue you've earned but haven't billed yet. You've handed something over, the cash is still coming. It's not a receivable. A receivable is money you're plainly owed, just waiting on time. A contract asset still depends on you doing more, like delivering the rest of the service. Small distinction, big deal to auditors. So what's the profit on day one? Under the old rules, the phone was free, no revenue, yet its 200 euro cost still landed. The result, a 200 euro loss on a sale that was genuinely profitable. Under IFRS 15, 240 euros of revenue meets its 200 euro cost. A clean 40 euro profit the moment the phone is delivered. The total profit over the contract is the same. Now it simply lands at the right time. Part 2. One model. Now watch it crack open any industry on earth. Here's the beautiful part. Those same 5 questions crack any deal. Take software. A 1-year cloud subscription, 1,200 euros. Used continuously. So, revenue spreads, 100 a month. But sell that software as a perpetual license, and control passes on delivery. All 1,200 at once. Same question 5, opposite answer. Construction. A 10 million project, no alternative use, with a right to be paid as you build. That earns revenue over time, by progress. 40% done at year end. 4 million recognized, even with the building unfinished. 1 model. Telecom, software, construction. 3 answers, same 5 questions. We've cracked the deal. But where does any of this show up for someone reading the accounts? Before, you'd see one lonely line, revenue 720. That's it. Under IFRS 15, the same sale tells a richer story. Revenue splits, devices 240, services 480, and the balance sheet now carries that contract asset of 240. And a note spells out what's still to come. 480 euros of service revenue over the next 2 years. The reader finally sees the shape of the revenue, not just a number. Remember those old interpretations? They didn't vanish. They're folded into the 5 steps. Loyalty points, the old IFRS 13, are now just another promise. Set some price aside, count it when the points are redeemed. Real estate sales, IFRS 15, now a question of when control passes. Transfers from customers and barter advertising, IFRS 18 and SIC 31, handled as non-cash payment. One framework now answers what used to need 4 separate rulebooks. Simpler. Part 3. The judgment calls, where the tidy model meets the messy real world. 3 judgment calls you'll meet in the real world. 1. Variable consideration, discounts, bonuses, estimated, but only count what's highly likely to stick. That's the break. 2. A big gap between delivery and payment. There's a financing element hiding in there. You strip out the interest. 3. Principal or agent. Control the good before it sells. You're the principal. Report the full amount. Just arrange it. You're an agent. Report only your cut. Get that wrong, and revenue balloons. But the real world throws more at you. First, a contract modification. Halfway through, the customer wants to add scope. Is that a brand new contract or a reshuffle of the old one? Get it wrong and revenue lands in the wrong year. And warranties. A basic, we'll fix defects promise is just a cost you provide for. But sell an extended warranty, and you've made a separate promise, a slice of the price earned across the cover period. Sell with a right of return. Don't book revenue you expect to walk back out the door. You park a refund liability and carry the goods you'll get back as a return asset. And here's a sneaky one. When you pay the customer, shelf fees, rebates, that usually isn't an expense. It comes straight off your revenue. Pay to sit on the shelf and your top line shrinks. Even your costs follow the revenue. The commission you pay to win a 2-year contract, you don't burn it on day one. You spread it over the life of the deal, matched to the revenue it earns. Same for the cost of setting up to deliver the promise. Capitalize it, then release it as you perform. At last, costs and revenue moving in step. And when revenue is earned over time, how fast? 2 ways to measure progress. By output, milestones hit, units delivered, or by input, costs spent, hours worked, same finish line, different speedometer, and licenses split the very same way. A right to access IP that keeps evolving, a brand you keep supporting, earns over time. A right to use, IP frozen as it is today, earns at a single point. Access versus use. That one word sets the timing. Once you see the pattern, you see it everywhere. A gift card, cash now, but revenue only when it's spent, plus a slice for the cards never used. Loyalty points, a promise saved for later, earned only when they're redeemed. An airline takes your money today, but books the revenue the day you actually fly. A streaming subscription spreads across every month you keep watching. Different industries, identical 5 questions. That's the power of one model. So, who felt this most? Telecoms and tech, bundles and licenses, unpicked and repriced. Construction, retesting over time versus on completion. Retail, loyalty and gift cards. Pharma and media, licenses and milestones. Getting ready means map each revenue stream through the 5 questions, find the real promises, set standalone prices, decide the timing, fix the systems, spreadsheets crack at scale, and write down every judgment because the auditor will ask. One more thing, bang up to date. In September 2024, the global standard setter finished its official review of IFRS 15, and the verdict? It's working as intended. The 5-step model was singled out as a robust way to handle even the messiest deals, with no overhaul needed. And because IFRS 15 was built hand in hand with US GAAP, the very same 5 questions run revenue on both sides of the Atlantic. It's been mandatory since the 1st of January 2018, and it's here to stay. Part 4. What all of this means for you, the person reading the numbers to make a call. Last stop. You, reading the accounts to make a call. Before, you got one figure. Revenue, $720. Compare it to a rival, hard, recurring, or one-off. No idea. Future sales, invisible. Now the same accounts answer all 3. Revenue splits into devices and recurring service. So you compare like for like and see what repeats. And a rising contract liability balance, paid, not yet earned, is a backlog of revenue still to come. A forward signal you simply never had before. So let's bring it all home. One mystery. How does a free phone earn money on day 1? 5 questions cracked it. A contract, 2 promises, a $720 price, split 300 over 900, recognized as control passes. And the answer, 240 euros of day 1 revenue parked as a contract asset. That is the whole of IFRS 15 in one breath. But zoom out to the whole 2-year contract, and here's the real headline. The total profit you earn is identical either way, €280. What IFRS 15 changes is how you get there. Under the old rules, a heavy loss on day one, then a slow climb. Under IFRS 15, a steady profit from day one onward. Same destination, but a far truer picture of the business at every point in between. So let's pull it together. Every sale in any industry comes down to 5 questions: the contract, the promises, the price, how you split it, and when control passes to the customer. That's how a free phone earns €240 on day one. In real life, focus on 3 things especially: variable pricing, principal versus agent, and the timing of licenses. Master those 5 questions, and no set of accounts can hide its story from you. That's the whole of IFRS 15. Next time, IFRS 16 and how leases finally landed on the balance sheet. See you there.